The banking sector is one of the most complicated sectors and an all-encompassing sector which basically goes and touches almost every other facet of an economy. And hence it's critical to understand and analyze it slightly in detail, understanding what kind of changes are happening around the sector at various points of time. It does become an important sector purely because it links with macroeconomics as well and is a guide to how macroeconomic policies are working in the country. In this session, we are basically going to do a quick understanding of how does a bank work. That's important for us to kind of go ahead and understand some of the issues that ail the banking system at this point of time. We will try and look at some of the key terminologies in the banking system. We will look at this concept of bank recapitalization that the government has announced and some of the newer trends or new news data that is available around the banking segment as such. That's the broader contour of what we're going to cover today in this session. How does a bank work? Now, unlike a normal simple system, a bank actually works on someone else's money. It accepts deposits from depositors and extends that money out as loans. Right now, that's in a very simplistic phenomenon where someone else is putting the money with the bank and the bank basically gives that money out in the form of a loan. In a very simplistic scenario, the bank would charge a rate X% here and pay a rate Y% here, and the earning of the bank would be X minus Y, right? That's what the earning of the bank would be, right? Now, obviously, in this kind of a scenario, there are challenges that would be there, and so to safeguard these depositors, the regulatory agencies would come in and start putting in certain conditions. The first condition should be that I can't operate a bank like this, taking 100% of someone else's money. I should be putting in some of my own money, right? So the banking system comes in and says that for deposits of 100, you have to have equity of 10. You have to put in your own money of 10. That adds up to 110. And now you can extend a loan of 110 on the other side. So we have complicated the system a little bit. We have added owner's equity here, right? That's the owner's equity here added. And we have taken the depositors here. The combination of these two gives us a certain amount of money, which we are giving out to the borrowers in the form of loans. This gets complicated a little bit further because obviously all the loans are not necessarily going to be safe. And you do want to safeguard both your depositors and your equity holders. So what do? You basically create something called as reserves. You would have heard terms called CRR, cash reserve ratio, or SLR, which is statutory liquidity ratio. So some part out of this 110 rupees that the bank collected, let's say 25% or 25 rupees out of that, goes and sits in the form of reserves. These are typically liquid reserves. And the idea of these liquid reserves is essentially that if something goes wrong on the loans front, or if there is a sudden surge of the depositors coming back to the bank and saying, please give us our money back, there is enough that is available with the bank at any given point of time, right? So the system works under the assumption that on any given day, not more than 25% of your depositors will come and ask for money. That's a broader assumption that is playing out in this banking system. In fact, this assumption is far more stringent. It is not even 25% because there is a possibility that a lot of these bonds are not completely liquid. You can't easily sell everything at any given point of time. So the system actually works under the assumption that on any given point of time, roughly 10 to 20% of your depositors are going to come back asking for money, worst case. It can't get worse than this, right? Now let's move further. In this context, let's assume something goes wrong with the loans, right? Which means roughly about 5% of the loans become what is called as non-performing assets, NPA, right? Slightly more than 5% in this case. So you're going to get only 80 rupees back. You're not going to get 5 rupees back. Let's assume that is the scenario. You're only going to get in 80 rupees, not the other 5. So at the end of this scenario, the bank gets back about 105, assuming 0% interest rate for the time being. It has to return 100 to the depositors, assuming 0% interest on this side as well. For the equity holder, you're left with 5, right? You started with 10 and you're left with 5. So the learning number 1 is that if a bank gives you 5% NPA levels, your stock price could halve. Your stock price could go from 10 to 5. And that's why when a bank comes and reports 1% NPA, it's not necessarily just 1% of the loan. It could be a much, much bigger issue here on the owner's equity of the bank, because you're anyway supposed to return the depositor money. After that, what is left could take a big hit if NPAs are large. So now when we look at some of the banks and we realize that they are sitting with 10% of NPAs, you can practically assume that the equity is going to get wiped out at that point of time, if all of this happens to be NPA does not get recovered at all, right? So that's the first challenge that comes in the banking system. The problem doesn't stop here. Note that we started with the assumption that for 100 rupees of deposits and 10 rupees of equity, you can extend a total amount of loans worth 110, right? That's what we saw. 100 rupees of deposits and 10 rupees of equity could get extended in the form of 110. Now, if you have 5 of NPA, then your equity falls down to 5. Now, under adequacy ratios, what is typically suggested is that, so what we saw was roughly 11 times of your equity is what could be extended as loans. Roughly 11 times of your equity could be extended as loans. Now, under that condition, you will only be able to lend 55. You can't lend more than 55. Even if this entire 80 is good, you cannot go ahead and re-lend this money. You will only be able to extend up to 55 if you are playing with equity of 5, right? Now, the only way you can grow from here is if you get more equity or you make profits, which go and sit as a part of equity. Unless you do either of these two, the bank cannot grow, correct? So that's the problem with the banking. And this measure, this concept is called as capital adequacy ratio. It's a measure of the bank's financial strength, basically expressed as a ratio of capital to risk-weighted assets. Forget the risk weight for a minute. Just assume that it is the opposite of debt by equity, in a sense. How much equity do you need to give out a loan of 100 rupees effectively? Right now, under Basel III norms, banks are required to maintain a minimum capital adequacy of 9%. The capital adequacy is divided into something called as tier 1 and tier 2, and tier 1 is supposed to be 7% out of that 9%, right? What are risk-weighted assets? Just to get a quick understanding, bank assets could be basically cash with RBI, government bonds, they could have given auto loans, they could have given home loans, they could have given other loans, right? In terms of the weights of risk, now cash with RBI is risk-free, right? So there is no issue in terms of the risk around this. Government bonds are also considered largely risk-free. So there is, I'm just using hypothetical risk weights here, right? This may not be the exact risk weights in the industry, but let's assume government bonds are also risk-free. So there is no risk-weighted amount. I'm just taking a weighted calculation here. Cash with other banks, you would ascribe a 20% risk to this money. You know, there is a chance that some of this money might not come back. Loans, secured ones, 50 and 75% weights, and any unsecured loans, for example, credit card loans, etc., whatever amount is outstanding as the asset, you'll put the entire amount as the risk-weighted amount, correct? So the risk-weighted assets are 51, and your equity, let's take a round figure, you should be 10% of this. So if the bank's equity is 5.1, you can run this business. If the bank's equity is not 5.1, it falls from 5.1, then you have to fund this equity again. You have to either make profit so that equity goes up, or you have to recapitalize this segment. Otherwise, this equity will be under trouble. And that's why banking becomes an intriguing system, because if there are NPAs, not only does it go and impact the stock price immediately, because that's the owner's equity which is going to take that hit, it also impedes the ability of the bank to grow further. So growth will also go down if NPAs are higher. So that's about the banking system and how it works broadly. You extend this basic analysis into an understanding of some of the other terms, and those terms would be, let's say, something like non-performing assets. So an asset becomes non-performing when it ceases to generate income for the bank. At this point of time, any loan that is overdue for more than 90 days is classified as an NPA, right? Total amount of loans classified as an NPA are called as gross NPA. So that's the total loans that the bank has outstanding, which are not coming back at this point of time, which are creating a little bit of an issue, that are more than 90 days overdue at this point of time, right? Now, every quarter, RBI stipulates that some provisions from the profits have to be allotted towards the bad loans. So every quarter from the profits, you have to put aside some money for the bank, for the bad loans. The money that you put aside reduces the gross NPA because you've already assumed it's a write-off, right? So let's assume my gross NPA is 1000 crore, correct? And I have put a provision of roughly about 400 crore in this quarter. What is left is the open amount of gross NPA. I have not made any provision around it. This number is called a net NPA. So that's my net NPA amount. These are non-performing assets which are currently at risk. The ones which we are provided for already have already been written off. From there, you can probably only get something back. You can't lose more. You already lost or written off that 400 crore out of this, right? So that's basically the definition of gross NPA and net NPA. Now let's try and gauge what's happening with the Indian banking system at this point of time. Gross NPAs in India at this point of time have been on the rise for the last few years. There has been a consistent jump in the gross NPA levels of banks. Now, there are 2 or 3 phases here that are important. The first phase is this area that you see, where there is a sudden jump. This is because RBI forced banks to recognize the NPAs. Right? Till then, you see the NPA growth is very slow. Banks used to typically restructure loans. What do you mean by restructuring a loan? If the loan was due in 2015, the bank would restructure and make it due in 2018. So technically, it's not an NPA any longer. You've just delayed the payment terms, or you've just delayed the loan becoming an NPA, right? RBI basically forced banks that this cannot be done. So you have to recognize the NPA. NPA levels immediately doubled in the next 2 quarters. From something like 3 lakh crore, it went up to 6 lakh crore by March 2016. This was largely bulk of the pain that was available was taken in the system, right? This is when the banking sector took a big knock and the banking sector stocks fell down dramatically. Post this, the banking sector stocks kind of revived because most of the problem was already on the table. You had recognized the problem and the problem was available to all of the people. Everyone knew what the problem was. Then there was a slight steady increase over the next 4 quarters. You suddenly see this last end of jump coming again. This is again because RBI now forced banks to recognize a certain kind of loans as NPAs. So there is a lot of divergence between, for example, what a private bank would show as its NPA and what RBI assumes as its NPA. If you look at the lists of something like a Yes Bank classifies about 1000 crore of loan as NPA. RBI says about 6000 crore of loan is an NPA, right? So some of the private banks basically have classified in this particular quarter results. And so that's another spike that's happened. Current gross NPAs in rupees crore is nearly 8 lakh crore in the banking system. That's a substantial amount of NPAs that exist in the banking system at this point of time. Now, out of this 8 lakh crore of NPAs, the biggest chunk goes to public sector banks. You see this period once again. This is where the NPA numbers suddenly jumped up in these 3 quarters. because RBI forced these banks to recognize those NPAs. So PSU banks basically towed the line immediately. And since then, PSU banking NPA levels have been kind of consistent or slight increase at best that has been seen. Out of the 8 lakh crore that we saw, nearly 90% is from the PSU banking segment. Correct? Now, what does PSU banking segment at 90% NPA do? There's obviously a problem of capital erosion because you do not have profits. You're going to write off that. You're making losses that will reduce your equity. And if your equity reduces, your ability to lend or your lending also will go down. Even if you're getting business, you can't take that business because you do not have enough equity. And so the lending or the credit growth of PSU banks is going to take a knock at that point of time. Who are the larger culprits? SBI, largest bank, sits with nearly 2 lakh crore of NPAs, gross level. PNB sits with nearly 60,000 crore. Now, this has to be seen with the perspective of the size of the bank. SBI market capitalization is nearly 2.5 lakh crore, right? Slightly more than that. PNB market capitalization, on the other hand, is about 40,000 crore, right? So market value of equity of SBI is 2.5 lakh crore and NPAs are lesser than that. In the case of PNB, NPAs are actually more than what you are giving in the form of market cap to the company. And so obviously the stocks will be under trouble at this point of time. They are reeling under NPAs. They are reeling under a problem that you are not able to recover this money. So your equity, or what is commonly known as book value, is going to get stressed and it's going down, and there's no sign of revival of that. And you cannot grow because you cannot lend further courtesy your lower equity or book value, right? That's the other problem that comes. And let's understand the implications of those issues. If you cannot grow, obviously you will lose market share in the economy. Let's understand the credit growth in India then. If you look at the credit growth in India, that's the blue line that you see, over the last 3 years, credit growth in India has been 8%, 13%, and 5%. This is credit growth, which is coming from the banking system, only the banking system, right? The orange line is deposit growth, which has been steady at about 10, 11% all through. So in the last financial year, credit growth dipped. Why did it dip? A large chunk of this problem is on an overall level, private banks actually saw a growth of 17%. PSU banks did not grow. They did not grow because they could not grow. They could not lend. And if you cannot lend, there is obviously going to be zero credit growth. And so credit growth was zero for the banks. Private banks did well. And who captured this entire growth that was left on the table? Non-banking financial companies. So in non-bank credit, you see a consistent rise in non-bank credit in India. And you saw a CAGR of 18%, and you continue to expect a CAGR of 18% over the next 3 years as well. And so that is where the problem is happening, that a lot of the growth is basically going from PSU banks towards the non-banking financial companies. Now, what are non-banking financial companies? All your housing finance companies, all your companies like Shriram Transport Finance, Manappuram Finance. All these are guys who are capturing this entire growth. Bajaj Finance, Capital First, etc., who are capturing this entire growth at the expense of the PSU banking system in India. They were doing it purely because the banking system could not lend. Obviously, there was lack of demand as well. The economy was not doing as well as you would intend it to do, but also because of this entire problem of PSU banks not having adequate capital, you were going to face a challenge that they can't go and take further risk. And so NBFCs did remarkably well. The share of NBFCs in total credit in India has increased to 16% from 13% between 2013 and 2017. And between now and 2020, it's expected to go up to 19%. So total credit, the share of NBFCs is expected to rise dramatically, right? And so that's been fueling the rally in the stock prices of a lot of NBFCs, but has been keeping PSU banking system under trouble. If you look at the share in credit exposure for large loans, mid-size loans, small-size loans, or micro loans, almost everywhere in the last 2 years, the share of PSU banks has gone down. Almost everywhere in the last 2 years, the share of PSU banks has gone down. Private sector has done well and taken some part of this growth, and NBFCs have done well and taken some part of this growth in that context, right? So obviously private sector and NBFC, both of them have grown at the expense of the PSU banking system. And so that stalls the entire growth in the PSU banking system from the perspective of the economy. From the perspective of these stocks, they were not going anywhere. You were not moving ahead because those NPA issues were not getting resolved. And even if you wanted to resolve the NPA issues, you could not grow because you did not have enough equity to go and lend further. Enter bank recapitalization. Now, what does bank recapitalization do in the first place? The Government of India announces a large bank recapitalization plan. This is to the tune of 2.1 lakh crore. Now, the nitty-gritties of how this 2.1 lakh crore is going to come and from where it is going to come has not yet been defined. There is going to be some sort of a bond issuance which is going to fund this, and then eventually that is going to get pumped in the form of equities to the system. But let's understand the implication of this first. First things first, it is essentially giving banks equity. What does equity do? Equity allows lending. So if there was a supply side issue, which is basically you couldn't lend because you did not have enough equity on the table, that gets resolved. From a signaling perspective, this is a very, very powerful signal, which basically tells that the government wants to resolve this entire scenario. The government wants to pave the way for moving ahead, right? It's positive for the sector as a whole, as with this 2 lakh crore, the banks can make more provisions. Remember, our total gross NPAs are 8 lakh crore. Net NPA number should be much lower. Net NPA number should be to the tune of 4 lakh crore. And if you pump in roughly 2 lakh crore, then half of that could be written off straight away. You could write off that half of the loan straight away and basically move ahead with the lending cycle. It resolves the supply side issue of credit in India, specifically for PSU banks. It gives them enough firepower to go and lend further. Now, what is the magnitude like? 2.1 lakh crore. If you look at the market capitalization of the top 10 PSU banks at this point of time, that's nearly 4.5 lakh crore. So you have actually announced a number that is nearly 50% of top 10 PSU bank market cap, right? Top 10 PSU bank market cap. And it's obvious that the stocks would then jump by nearly 30 to 40% on the day this is announced. In fact, these numbers of market cap that you see at this point of time are as of today. So the day it got announced, these numbers were even lower. And you see the 10th largest bank has a market cap of just 7,000 crore. So everything else that comes in will not add up to more than 15-20,000 crore all put together. So effectively, you have signaled that nearly 50% of the total PSU bank market cap is available in the form of new equity that is issued to the banks. The moment this equity is issued to the banks can lend. Now, once banks can go ahead and lend, obviously stock prices improve. There are further implications of this entire exercise. The first implication of this exercise is PSU banks can lend. Now, typically PSU banks have a strong rural reach. Rural reach should give you a lot of retail loans, and within retail loans, you should be able to capture the largest segment. What is the largest segment of retail loans? Home loans. And so if you look at home loans, the companies at risk, are largely housing finance companies. The ones which are extremely dependent on housing finance, they are the first ones who are going to get hit by this entire scenario. And if you go and look at some of the housing finance companies and their stock prices, leave aside HDFC, because that's the largest one. But if you look at anything else in that pack, which is in the housing finance segment, PSU banks are expected to basically take up their market share again. They are expected to gain their market share again, which they lost to the NBFCs. And so consequently, the first set of companies that might come at risk initially is the housing finance companies. Of course, over a period of time, good performance has to be continued, and you can't expect that PSU banks will keep taking market share. But in the very near term, while PSU banking stocks went up, you saw housing finance company stocks went down, right? So that's one of the things that comes out of this scenario. The second thing that you would want to question is obviously, is this good? Is this correct to actually recapitalize bank? Because you are technically allowing them to write off the loans, right? Write off NPAs. Now, that's not a great thing, right? Technically, you shouldn't allow them to write off NPAs. Now, the problem with Indian banking system is that you know that NPAs are there for the last 5-6 years. And whatever you try to do to resolve those, there are other measures that have been taken around that. But you can't resolve that unless you once write it off. Now, not writing it off because it assumes that this will go and happen again in the future is definitely not going to help anyone. So the government says that let's write off these for once and let's tighten everything else. So one of the things they have tightened around this is the entire bankruptcy law that exists, right? Historically, you could have the promoter bid for the company in bankruptcy proceedings. So the promoter would basically go and lend or borrow a lot of money and then not repay that money. The stock price goes down, the company goes into bankruptcy. Suddenly the promoter gets money and goes and bids for the company at that low stock price and buys it again, right? Now the government has basically said the promoter cannot do that. The promoter is barred from bidding in that bankruptcy proceeding. Now, it seems harsh in one case, in genuine cases, but a lot of the times this has been misused in the past in India, and that's what this goes and tightens right away. And because it tightens that right away, that essentially is another step that is happening along with writing of these loans, allowing the banking system to move forward. If the banking system moves forward, if the credit supply is created, that enhances the entire growth possibility for the economy. And that's precisely why this bank recapitalization step has been taken. So positive for PSU banks, intermediate term negative for the NBFCs who captured a lot of market share from PSU banks. Uh, Private banks, I think, should continue to kind of go around their own path in terms of reasonable growth. That's the near-term implication of this recapitalization. We'll get more sense when there is actual clarity on how this money is raised and what kind of money comes in. That's what we're going to see when that gets announced. Now we move ahead to something else, which is called the credit deposit ratio. Credit deposit ratio is the aggregate credit or aggregate loan that is given out by the banking system divided by aggregate deposits that the banking system has. Right now, historically, this number used to be in the range of 74 to 77% roughly, right? Around demonetization, this is the time around demonetization, you suddenly had the deposits going up. So you're finding credit to deposit ratio, deposit went up around the demonetization time. And so suddenly the credit deposit ratio goes down to 69%, right? Since then, the banking system continues to grow and credit deposit ratio is now standing at 73%. Now, there are certain implications of credit deposit rate at being 73%. One of the implications is essentially that your loans are growing faster than deposits, right? If loans are growing faster than deposits, then that could be possibly because of lower interest rates. That could also be possible because of the fact that probably some of these PSU banks or other banks are capturing what they had lost in terms of market share from NBFCs. Remember, this is only credit deposit for the banking system, right? So when credit to deposit ratio is going up, that basically tells you that credit is growing faster than deposits, which means banks do not have enough money. They are lending more, which basically means that if they do not have enough money, interest rates cannot fall. Interest rates are supposed to go up. And that's what you are seeing in the bond yields of Government of India at this point of time. Bond yields have started spiking up. In fact, they kind of dipped a little bit somewhere here around the Moody's announcement, but have since continued to rise purely because it seems that interest rates are going to rise. There are other implications to interest rates, obviously. One of the portions is that credit deposit rate has gone up. Because deposits are not growing, banks have started increasing deposit rates. If banks have started increasing deposit rates, they are going to hike interest rates. So interest rate, the cycle of interest rates easing has stalled for the moment. Secondly, crude prices have gone up, which has resulted in inflation expectations also going up. And so consequently, RBI has also paused for the time being. They're not cutting rates. And widely, it's expected that you're not going to see too much of rate cut happening in the near term, at least. So practically, this cycle of interest rate easing seems to have been fulfilled. You don't expect more interest rate cuts to happen in the near term. And so consequently, bond yields have started hardening. Bond yields hardening would result in losses. Why? Because bond yields are inversely proportional to bond prices. We know that. And so losses on bond portfolios for banks are going to happen. So you might see certain losses in the other income portion of banks. That's one possibility that's going to happen. Second, I think this is going to come and impact the credit growth any which ways because interest rates are headed slightly higher. We'll see how that plays out over the next few months or so. But it does seem that the entire cycle of bond yields kind of going down starting 2014, this entire down cycle has now stalled and has now started moving to the higher side. That's the game around bond yields at this point of time. What's happening in the credit deposit ratio and what view that gives us from the perspective of interest rates in the economy. If interest rates are not expected to go down too much, then because of that, the banking system will face certain amount of pressure in terms of lending money. Let's now move our focus to some of the newer areas where a lot of traction is happening. So one part that is going to be very interesting in times to come is this entire micro, small and medium enterprise in India, MSME sector in India. Total number of MSMEs in India that are registered at this point of time are nearly 5.1 crore, right? This is 2-year-old data, 5.1 crore MSMEs, out of which 4 crore have current accounts, but only 40 lakhs or 45 lakhs have borrowed any kind of money. So there is a huge gap in terms of the overall number of MSMEs versus those who have borrowed any kind of money. This is a segment where a lot of the NBFCs are targeting. MSME finance is a segment where a lot of the NBFCs are financing and NBFCs are targeting, and these NBFCs could see elevated growth over a period of time in the times to come, purely because this is a segment that is underserved, underpenetrated at this point of time in the country. So that's about the MSME segment. Digitization or technology is also easing the entire process of disbursal of loans, right? Just take a look at this chart on the right side. This talks about something called as TAT, turnaround time for a loan. When you go and apply for a loan, how many days does it take to kind of come up with that loan application? And you see the highest number of days, the days are here on the y-axis. The highest number of days are taken by PSU banks, and the lowest or the fastest disbursal of the loan is done by NBFCs on any size of the loan, right? So practically that's why NBFCs have been gaining traction because of the technology movement that has happened. Once PSU banks also imbibe the entire new digitization and technology, turnaround times are going to go down. If you look at the broader segment of how this entire disbursement, etc., happens, you would realize that a lot of this is now done by technology. You can basically request financing, your basic data and info capture and eKYC can happen online, credit bureau check can happen online, fee collection can happen online, sanction can happen online, ecosystem for data, digital disbursement, digital signature, and instant disbursement, everything can happen online. What that does is you could practically do this in a fraction of a minute, and a website like Flipkart could actually tie up with an NBFC And if you have your eKYC and Aadhaar and credit score available with you, you could practically go and buy a consumer durable right while checking out uh, using a loan from an NBFC. And that's the next stage that is going to come in, either an NBFC or a bank, which is going to expedite this process of lending to consumers. One of the largest segments is consumer durables that is facing this entire scenario. And so we are hopeful that this aiding of technology should basically make things much more interesting as we go along, or faster as we go along in the banking system. At this point of time, there are 64 crore active bank account users in India, but only 12% of them are online banking users, right? And reason for not, so there are another 25 to 26 crore that are on internet, but they're not using online banking. And either they believe it's too complex, or there is hidden charges, lack of transparency, lack of trust to the online system, which causes that. Reason for not using online banking is that, and reason for not using mobile banking apps is either they don't know how to use it, or they don't know about the app at all, or they fear hacking into the system because it's on your cell phone. Plus, there is nearly a 31 to 32 crore users who do not have internet access at this point of time. This entire segment of people, nearly 50 crore users, could get online and start becoming more conversant with technology over the next 5 to 10 years, which could significantly improve the penetration of the banking setup in India, the way it goes and touches the nooks and corners in general. Plus, your active banking segment is anyway going to increase, right? So that's about technology aiding faster disbursals. The other thing that has happened post demonetization, and the fact that there are more people using banking accounts and you have made usage of gray market money difficult, has also resulted in mutual fund assets under management growing dramatically fast. The number that used to be somewhere to the tune of $170 billion till about FY15, at this point of time is nearly twice of that number, right? So within 3 years, the assets under management of mutual funds have become twice the total assets under management. This is still minuscule when you compare it to global economies, or when you compare it to economies, the size of US. If you look at India's GDP, which is about $2.5 trillion dollars or $2,500 billion dollars, and you look at mutual fund AUM, which is about $333 billion dollars, and you take a ratio of this, that's about 13%, right? 13% AUM to GDP ratio. Whereas if you look at something like a US, the number is about 90%. Right now, 90% is obviously a slightly different statistic in US because pension funds and everyone is allowed to invest there. But the word average, which definitely gets skewed by the US, is also 35%. If this number grows further, you would see the mutual fund industry in India grow dramatically. That has also, gotten online. So ease of transaction has become an interesting phenomenon there. And this is something that could start competing with a lot of the funds that banking system gets at this point of time. And so it's an interesting play that is coming up in the next few years, where all the deposits in the savings account and current accounts of people who, or companies that used to exist, will start moving towards the mutual fund segment, purely because of better penetration, understanding, better technology, and more awareness of all these products that exist. And that could lead to a certain amount of pressure on the banking system in terms of where do they get their funds from. So that's broadly it in the context of our understanding of this entire thing. One final thing that I would just touch upon, which is just going on at this point of time, is this FRDI bill that is going on at this point of time, which is called as the Financial Resolution and Deposit Insurance Bill. Now, the banking system has proposed something called as bail-in, which basically says that if something goes wrong with the bank, the depositor's money could be taken to support the bank. It could be converted in equity rather than government coming and putting in equity in the bank, right? What you're saying is that the depositor could basically give that money in the form of equity. Now that's a slightly odd idea at this point of time. This could result in a little bit of a panic in the depositor, especially in the PSU banking system. However, just to understand rules better, even today we only have a 1 lakh rupee guarantee out of our deposits. So if you have 5 lakh rupees in the bank account and the bank fails, your guarantee that money is going to come is only up to 1 lakh rupee. And so far, this bill does not give any kind of limit in terms of what amount is guaranteed. So it's unlikely to change dramatically from where it is today. Having said that, in the past, the government has always supported depositors. That's been the last resort. We'll see how this plays out. There is some news around it. We don't have complete clarity about this FRDI bill at this point of time, but it doesn't seem to be, too draconian from what exists till date. On paper, what exists till date is that if something goes wrong with the bank, your deposit is only insured up to 1 lakh rupee, right? The bank is, in the fine print, the bank says they can take your money in the form of deposits to be converted to equity or some other fashion for their bailing in at that point of time. They've never done it in India, but that doesn't mean they can never do it. FRDI bill basically proposes a more stringent guideline around that. It's just remaining to be seen. The government has come out again and again and soothed the concerns of the depositors that this is not going to create too much of a problem. Let's see what plays out here. This is something that is not completely clear at this point of time, but I thought we should just quickly touch upon this entire thing just in case we understand the concept of this bail-in that can happen. So that's it from me in this particular session.